Welcome to the first live stream during the NFL football schedule. It's 1 p.m. Pacific, so we're looking at the games that are finishing, the first set of games that started today, and we're going to have afternoon games and then Sunday night football. So I want to talk about football. I want to talk about stocks. I want to talk about the stock market that's coming up. It's my fun day, man. I love football and I love stocks. So I bring it together on Sundays, kind of spend the day, take care of everything I'm supposed to take care of around the house early, right? Get the honey-do list done, get those things done. Worked in the garden with my wife this morning and did a couple things around the house. And now I'm watching the end of the Las Vegas Raider Baltimore Raven finale. Looks like there's 2 minutes, 12 seconds left, and the game is tied at 23 apiece. It's coming down to the end. I also watched earlier the Chargers really dominate their opponent, and Chargers are looking good this year. 26-3. They beat the Carolina Panthers. So it should be interesting. And the stock market, we'll see what kind of market we get this week. It was a week where we had a rise in the stock market that followed a big drop the week prior. So I still happen to think that we have, a correction we need a correction to the system, so to speak. And the reason for it is that, we've had a pretty good year. We had a correction in the month of August, and then the market came back. We had a correction the first week of September, and the market came back. But there's a lot of seasonal pressure on the stock market in the month of September and the month of October. And this year, we get a little extra fear and anxiety because we have a huge election. I mean, the election has a lot of tension, it has a lot of anxiety on both sides. And I think it's just going to be a little too much for a lot of investors. I'm glad that I've got some cash. I've tried to drum up more cash, and I'm looking for other ways of just increasing my cash level a little bit more, because I do feel like we're going to get a pretty good correction, and I want to have enough cash to buy into stocks that I believe in, buy into companies that I want to own. It's getting harder and harder to find really good deals on stocks. It's easier to find stocks that are really overpriced. And we'll see. We'll see how things sort themselves out. But it's really been a really volatile market this past month and a half or so. And we'll see what kind of market we're going to be faced with. Looks like we hit the high 2 months ago, and we went down. Then we went up. Then we went down. So what are we going to have for the remainder of September and October? We'll see. We will see. Thanks so much for joining. Whether you want to talk about football or you want to talk about stocks, I would love to talk about either. There is one stream of thought that I wanted to get into somewhat early, and that's you guys have seen me do analysis on stocks and use my intrinsic value worksheet. And some of the feedback I get is some people are a little intimidated by looking at the numbers within the financial statement. I can understand that. Financials are hard to read. So I wanted to do this. I wanted to take a look at a stock, and I'm going to use the Gemini AI app to ask it questions and then get the data points that are needed for my schedule. And I was doing this earlier, and the Gemini AI was really accurate. So let's give it a whirl. Let's take a look at a stock and see how close we can get with Gemini AI, which would make it really easy for investors to just go to AI and ask for certain fundamentals, put it into a valuation, and then make your own valuation on the fly. So I'll go into that, and I'll cover any stocks that you guys want to cover. So just let me know. So let me start off with a stock that I wanted to cover earlier today. Let's go over Nike. That's a nice stock that I could sink my teeth into and take a look at. So everybody knows who Nike is, and it's a company that produces footwear, athletic footwear, pretty popular in the NFL. I think a lot of athletes wear Nike, and I'll go over like the analysis I did in June 30th. And back then, I saw the cash flows were $6.9 billion. And that's taking 2023 numbers and having that as a starting point. And the way my model works is I look at cash flows, which is the number one method of valuing companies by investors, long-term investors like Warren Buffett, Charlie Munger, you name it. Cash flows tend to be the best fundamental to look at to value a company. And also look at earnings per share. So I'll look at both for Nike, and I'm going to use Gemini AI to give me the data. So let's get into it. So let me get this screen to be a little smaller. So that way we can see both things on the same screen. We can see Gemini do its thing, and we can keep an eye on this spreadsheet. And this is actually a Google sheet. I upgraded from spreadsheets to Google Sheets. Cyan Ken. So you want to look at FICO. What you think of FICO? I've never seen a chart like that. Company has a big moat. Yeah, I know who they are, and I have looked at them, but it's been a long time. It's a really good one to look at. So let's take a look at it. All right. And I've got a couple of stocks in addition to that one that I could also look at, but we'll get going. After I get this example going with AI, after I do it, we'll look at FICO. All right, so we got that one rolling. Now let me open up a second browser here.
Antonio hears about his game management. He, as we mentioned, has Marvin Lewis on the sideline with him to help him in these situations, along with Matt Sheldon, the director of football research and strategy. Antonio saying that with about 5 minutes to go in the second quarter and fourth quarter, the three of those men.
Okay, so if you're not familiar with Google Gemini, I get to my Google. I'm on a Chrome browser, and then I go to Gemini within the selection. Once I log into Chrome and I log into Google, I should say, then you're faced with this user interface, which is, "Hello, Victor. What can I do for you?" And this is AI. All right, cool. So let's ask it. The first question is, what is Nike's annual free cash flow? And bingo, just very quickly, it answered the question. All right. 1 point. So what I do here is this is for the fiscal year ended May 31st, 2023. It was $6.6 billion. And what I'm going to do is I'm going to take $6.6 billion plus the growth rate that I have for Nike. And the growth rate I have is 10%. So I'm going to go with $6,617,000,000 times 1.1. So it adds that 10%. And we've got our beginning, and this is going to be updated to FY 2024. They have a fiscal year that ended in May, and we multiplied that times 1.1. Okay, so we started year one, and then we're going to grow each year by 10%. And then terminal value on Nike is going to grow by 4%. Okay. All right. So far, AI made it easy. I didn't have to touch a financial statement. Perfect. Now, discount rate, I have to make that decision because what kind of rate of return do I want and how risky do I feel Nike is? I don't think Nike's very risky. They have a good balance sheet, and a rate of return of 8% is good because interest rates are down. And so 8%, I'm going to keep it. I had already made a decision on that. All right, so we got through the first question we got the free cash flow from AI. Now, the intrinsic value of all those cash flows, and it's calculated by this Google Sheet, is $199 billion. Now, I like adding cash, so let's ask AI, hey, what is the cash? So what is Nike's cash balance? All right, Google AI, getting it done. So it's telling us that it's $9,860,000,000. Man, this is easy. What is Nike's total debt? Total debt, $11.95 million. And I had 1 0 too many. So cash adds to the value of the company. Debt takes away from the value of the company. And we've got equity of the total equity value of the company is 197 billion. All right. So I don't need AI to tell me the market cap. That one's too easy. I would just open up one of my favorite apps to look at stocks, and that's Stock Analysis. So I'm showing you that AI is going to be a pretty good little tool, huh? Like you can just ask it questions and get the fundamentals we need. You don't even have to touch a financial statement. All right. So market cap comes straight out of the Stock Analysis website. All right. Net income, we don't need that number. And then shares outstanding, 1.5. That's still the case. We're good. And we're good. So I just filled in all the necessary information. It's saying, my model is saying that each share is worth $130 per share. The current share price is $79.00. So it's discounted by 65% if we look at free cash flows. So that looks good. Thank you, AI. AI made it super easy. Now, earnings per share is pretty easy to get because, again, on Stock Analysis, you can see that many analysts cover this stock. And you can get to the prediction from all these analysts of where the earnings per share is going to be. This year just ended. So I'm going to use this year, which is the forward year, the next 12 months. It's $3.13, and it's going to grow roughly about 10% per year. So it's $3.13. P of 24 is fine. Growth rate of 10%. And the stock is almost fairly priced. It's discounted at a slight discount. And the discount available on Nike, in my opinion, is 45% because the cash flows are so valuable. And this is a really strong company. I mean, you look at Nike, they're the number one player in athletic footwear and apparel as well. In the NFL, which is a game I'm watching, and by the way, the Las Vegas Raiders took a 3-point lead. And it looks like there's 1 second left. So the Raiders are probably going to win this game. A lot of them are probably wearing Nikes. So that's a pretty good return on Nike. And we just used AI to complete the analysis very quickly and easily. How's that, huh? I guess AI is beginning to mean something. All right, Sion Ken, Shadow Guy. Thanks for joining, man. So I don't know if the NFL is popular in Switzerland. Is it popular in Switzerland? It's the number one sport in the U.S. It's huge. Even Taylor Swift is a fan. But I love watching football. I just wish the athletes wouldn't get hurt as often, but it's just a physical game. So we're going to look at FICO, and then we're going to look at Clove. I can't tell you, I've heard of Clove. I'm not exaggerating. I've heard of Clove 10 times in the last 7 days from multiple people in the community. We have a Discord going on, and it's everywhere. It's like, what the heck, man? I'm going to look at it and see what the heck's going on with Clove. Why is it coming up so often? Let's take a look. All right, I'm going to keep my Gemini AI app going because it's beginning to be a little asset here. All right. So let's go to FICO. I like starting looking high level at the company. Now, FICO, as I understand, is the company that does like credit scores. And so this company over the last 5 years, man, it's done really well, up 500%. Over the last year, up 109%. And let's see. So the stock's really done well. The PE is really high. Wow. It's really high. So what gives? So let's take a look at high level, the company growth rate, like on revenue. I believe FICO, they do a couple of things, basically credit scores and stuff like that. So Fair Isaac Corporation develops analytics software and digital decisioning technologies and services. Got it. Yeah. I know that they provide scores and then people can get credit based on their FICO score. If you have a very high FICO score, that means you're very credit worthy and people will lend you money. You can get a car loan, you can get a home loan, people can lend you money. And if you have a low FICO score, it means you've had a couple blemishes and your interest rate's probably going to be a little higher. All right, so just a quick update on football. The Raiders beat the Ravens. They came from behind 26-23. Pretty good finish there. I wanted to check out. I'm going to get back to FICO. One moment, please. I've got to keep up with football because that is one of the priorities today. Today is a combo stream. If you want to talk about football, let's do it. If you want to talk about stocks, let's do it. But I like football a whole lot. And for the next couple months, I watch football on Sundays. I don't do sports betting till the end. I love stocks. And the thing about betting versus investing, right? I just don't think betting is a whole lot of fun. I guess I could analyze these teams and think, who's going to win or lose. But I already do that for stocks. And I make money at stocks, and I'll just stay in that lane. But I don't gamble on sports. All right, so we're going to look at FICO, Clove. It looks like Tillian wants to look at, I think, MELI, which is it Mercado Libre? We'll take a look at that company. That stock's been doing really well. Last time I looked at it was maybe a couple months ago, and it was priced a little too high. Let's see if it's a little lower. All right, football update. Now watching the LA Rams play the Arizona Cardinals, and the game just started, and the Cardinals are on top, 13-0. And they will have a 1-point conversion. Looks like they'll probably make that conversion. It'll be 14-0 against the Rams. So Rams better pick it up. All right. So Scion Ken, you want to look at DraftKings? All right. Let's look at DraftKings. Every time I look at DraftKings, I should say I haven't looked at it in a long time, but when I looked at it, it didn't present a big discount. So we'll see where it's at now. And then we can check out, looks like Bobby Jane. Look at GGAL. All right, we can look at that. All right, back to FICO. So we've got FICO. We know what they do. Let's take a look at their growth revenue-wise. Impressive that they're growing. They are a little small, right? Their revenue isn't gigantic, and they've been around for a long time. They've been around since the 50s, 1956, and they're still relatively small. That's interesting. I guess they're expanding their services, products, but it's nice to see green on the screen. That is good. That growth rate looks good. They probably have very good profits because they don't have to make anything, right? Look at the cost of revenue. Only $341 million but the top line revenue is 1.6 billion. So that's good. All right. So when we look at cash flow, free cash flow is $562 million. Now, back of the napkin, and heck, let's do an analysis here. We'll take a look at the model and see what my model says FICO is worth. Okay, so down here, I'm going to copy the template. That way I could reuse it. One second. I'm trying to move this field up. Okay, cool. All right, so now I think I could do this. So all right, hang in there with me. I just need to correct this a little bit. Make sure it looks clean. Come on now. All right, so let's take a look at FICO. I'm going to copy my model, and then we'll be able to take a look at it. I just migrated over from Excel this past week. Really glad I did so. And looks like I'm got a little bit of a learning curve. All right. So we're going to look at FICO. And this is, I forgot the name, Fair Isaac something, right? It's a pretty solid company. I'm going to guess that since it's a small company, I'm going to go with a discount rate of 9%. It's a very well-known company, not a lot of risk. The free cash flow is 562, has been growing, as you can see, over the years. So that's good. And if you look at the growth, it hasn't been great, but I'm going to say it's about 10%. Okay, we can go with 10%. So we'll go trailing 12 months times 1.1. And the trailing 12 months is 562 times 1.1. So the starting cash flow for this company will be 619 million. Is that what I expect in the next 12 months? And we'll grow it at 10% ongoing. That might be a little too optimistic, but let's just see where we end up. So the intrinsic value is $13.4 billion. So we got the cash flow. Now let's look at the balance sheet to get cash and debt. So cash equivalents is 156 million. And we've got total debt of $2.1 billion. So that decrements the value. So the equity value is $11.4 billion. The market cap is $45 billion. Wow. Yeesh. This company doesn't produce a lot of cash. So why is it valued so darn high? It's probably earnings per share. We'll look at that next. So we are at a market cap of 45 billion and shares outstanding are 24 million. Okay. So 24.52 million. The stock price is okay. So this thing, the cash flows are not very good for FICO. So it's not it's not calculating a very good value. Having said that, let's take a look at the earnings per share. 12 analysts cover FICO, and it looks like for the 2024 year, it's expected to be $24.13 per cap. It's supposed to grow by 20%. Now, I'll give it a 24, and I'm going to grow it at 15%. I guess I'll grow it at 20%. So the PE is just really high. So I don't quite understand why FICO is valued so high. They're not generating a ton of cash. The earnings per share is not creating like a stock value that's really high. The stock has performed really well over the last couple of years. And I just don't understand why the story is so positive by investors on FICO. The fundamentals don't show that this stock is worth as much as they say it's being priced at. Analysts believe it is overpriced by 15%. I believe it's overpriced by far more. When we look at the stock over the last 5 years, it's really gone up 500%. So if stockholders have done really well, congratulations. It's still, I think, relatively, I mean, it's not a small cap anymore. It's 45 billion. Interesting. Yeah, that one there, I wouldn't touch it because it's just, I need to stay in my lane. I find companies, they look good. I buy them. Stock values go up. This one's outside of my qualification, and I would pass on Fair Isaac. All right, so that's the first one out of the gate. Hopefully you found that interesting. We've got, hey, Brad, how you doing, man? So your comment is, so let's see here. Good afternoon, Victor. Do you think we will have a pullback next week in the market or push up again? I think that we're going to, at the end of October, let's call it after the first week of November, I think stocks will be 10 to 15% lower. And having said that, I would not be surprised if there's a sell-off next week. I would not be surprised if we have a couple of ugly days like we had the first week of September. I don't sell off my stocks. I keep my stocks. I believe in the companies that I own. But September tends to be a month when stocks sell off. So does October. Some of the worst crashes, like one-day crashes, have happened in September, October. It's just that season. It's a season when investors sell. And there's more reasons to sell this year. Just sell your stocks at a gain, wait it out for a couple months, see what happens with the election, come back and buy in late November or December. That totally makes sense. And that's my expectation over the next 6-7 weeks of trading. It doesn't mean I'm selling my positions. It just means, I'm accumulating cash wherever I can, just getting ready because I think we're going to have a pullback. I'm also, shorting a few stocks, and those shorts I'll be monitoring. I think they're going to do well. I think my bonds are going to do well over the next 7 weeks. My bond portfolio has been doing great for the last 2 months. All this volatility, the stock market goes up and down, and it's somewhat unpredictable, but bonds have just been going up nicely, having a very good yield. And now you know why the bond market's much larger than the stock market. Big institutions can really depend on the bond market. When they expect it's going to do 6% rate of return, it does 6% rate of return. It's nice and smooth. If it goes up and down a little bit, that's about it. So the bond market's really been doing really well over the last 2 months. So thanks for the question, Brad. Thanks for joining. I think Georgia played yesterday, right? I watched a little bit of the game. It was tied 3-3. I think they were playing Kentucky. And I didn't watch the whole game. So I'll need an update on that. If you can give me an update. Did Georgia win? What was the score? All right, so we've got a couple more comments. So we've got the thing about FICO is that I don't think intrinsic matter because the stock always goes up without major dips. It may be, but it's going to go up until it doesn't go up. And then what's going to hold it up, right? I can't argue with the return. It's a phenomenal return. It's just not the right recipe for me. I have to find a recipe that, I find companies are undervalued, they go up, and it's based on intrinsic value. That's not a foreign concept. That's the concept that Warren Buffett uses, that Pat Dorsey uses. I mean, some really legendary investors going back 100 years. This is like a technique that's not new. It's intrinsic value. It's the value of those cash flows. So it looks like we won, but had a tough time in Lexington. Wow, 13 to 12. Whew. Looks like Kentucky really wanted to win, but congratulations. To get out with a win on the road is always a good thing. All right, good stuff. So, yeah, I mean, I would pass on FICO. What's the point to own FICO till the end? Has a comment, because it'll be here for the next 100 years. Yeah, maybe. Till the end, rate cut could be priced in. Cyan Ken. I think market will be flat leading up to elections. Yeah, I don't know that it's going to be flat. I mean, judging from, and I'm so I would say, yeah, it's going to be flat if it wasn't this crazy. I mean, this is pretty nuts. In July, we were here. Stock market sold off very quickly. And on the NASDAQ, it corrected more than 13%. And then it went from there and just took off. And then from there, it dropped. And then from there, it took off. It's like, okay, I'm not expecting smooth and to be even after 7 weeks. I'm expecting continued volatility, up and down, more down. So I appreciate your comment, Ken. All right, cool. So looks like Alabama's next. Good luck. Is Alabama really good this year? I'm not keeping up as well with college football as I am with the NFL. On both, I love watching the games, but I don't make any predictions at the beginning. I love the end of the season when you get the playoffs, man. It's like incredible games. And it's cool that college football, you now have a playoff. That's super cool. So go college football. All right, we handled FICO, provided a comment out there. Hopefully you found it interesting. And it's just I'm one investor, okay? I show you my process. I show you my investing thesis. I talk about the stocks that I do own, which stocks have really worked for me, which ones I've lost money. FICO is one I'm going to pass on. It doesn't fit my criteria. It's probably a good investment for somebody else, but we'll see where it goes. It's going to keep going up until it doesn't, and then we'll see what props it up, if anything. All right, next one up to bat is Clove, CLOV. This one I've heard a lot of. So this, what's it been doing? So it's up 164%. That's pretty incredible. It's a low price stock, and these, on the face of that price, it's riskier. Stockholders don't like really low price stocks because they went down for a reason, right? So let's look at 5-year. See, they went down for a reason. Back here, they were $16 and they got sold off. And the market said they're only worth 4 cents on the dollar, which is incredible. Let's take a look at their fundamentals. So these guys, let me just glance at what they do. So Clover Health Investments provides Medicare Advantage plans in the United States. It operates 2 segments, insurance and non-insurance. It offers Clover Assistant, a cloud-based software platform that enables physicians to detect, identify, and manage chronic diseases earlier, and access to data-driven, personalized insights for patients. So they're doing a combination. They're what I think is classified as a healthcare payer. They're a health insurance company that participates in the Medicare Advantage. When somebody's on Medicare, they can elect to have additional insurance in addition to the Medicare that the government provides. And that's what these guys do, as well as they provide a software so the doctors can use it. Interesting. When we look at their financials, revenue was really going up. They were small in 19. They've grown nicely. And revenue really went down in 2023. Revenue was really high in 2022. And let's look at the quarterly. The good news is that revenue is beginning to grow. That's very good news. Okay. This may be coming back. Obviously, the stock's really appreciated over the course of a year, so it might be going places. So we've got quarterly growth is good. It had a really tough 2023. Does it produce free cash flow? Free cash flow, it does not. So it's negative free cash. Now let's look at the quarterly and see what the story is here. Okay. All right. They are producing free cash flow. So that's encouraging, right? You have a company that's growing, getting larger, having more scale, being able to offset some of their fixed cost across a bigger revenue number. And now in the quarterly, they're beginning to generate free cash flow. Okay. All right. I'm interested because this is like a rebound story, and it's already rebounded quite a bit. Now, my best guess, if we went out on a limb and we said, okay, this is representative of 6 months, 2 quarters, and collectively that's about a $70 billion free cash flow rate for 2 quarters, times 2 to annualize it, that'd be 140. So I'll use that in a model. 140 of free cash. The growth rate in the quarter looks good. Let's look at the balance sheet, make sure this company doesn't have a ton of debt, lots of problems. The balance sheet, to use a football analogy, if I may, the balance sheet's like defense. Like a football team, their offense, like Patrick Mahomes, he's incredible, throws a touchdown pass, everybody cheers, awesome. But what's oftentimes not really seen is how the defense plays and how the offensive line plays. And the balance sheet could really be a huge liability to a company. If they have too much debt, it's probably going to spoil a good idea, a good business, because they're always going to be trying to pay their debt payments, and it's going to absorb all the free cash. It just constantly is a big burden on the company. So that's why I look at debt. So their total debt is $4 million. So that long speech I just gave you doesn't matter. They have no debt. And they do have some cash, I hope. So yeah, 254. All right. So let's kind of model this. And this company is a higher risk company. I don't know that anybody's going to argue with me on that. It's a higher risk company because it's smaller. It just went through a big revenue drop. So I'm going to say, hey, stock market, I want a 12% rate of return. This is higher risk. So I want a higher rate of return. Now, free cash flow, we said it's probably going to be, our estimate. and it's going to be $140 million. It's beginning to grow, so I'll grow it at 10%. That's fine. Based on the free cash flow, the cash flows are worth $1.8 billion, and the cash on the balance sheet's $254 million. They had $4 million in debt, so the whole equity value of the company is $2 billion. They currently have a $1.5 billion market cap. Shares outstanding are 497 million. So it provides a discount on free cash flows of 42%. Now, here's what I would say about a company like this is if you think they're going to make it, if you think they're going to grow, it's pretty much a pretty solid situation because their cash flows, if they continue to provide free cash flows, it really does value the company well. So on the free cash flow side, this looks promising. Now, when we look at their earnings per share, they're going to lose money for the next couple of years, so I can't use that. So I can't use this. It's really, I can only look at free cash flows, which is the method that I really depend on most. So if you really believe in the clothes business and you think they're going to go places, I could see it being a good investment. I'm good with healthcare. The healthcare stocks that I have, and I'm very happy with them, is Catalyst, doing really well with Catalyst, doing really well with United Therapeutics. Take a look at that business. It's phenomenal. Pfizer. And then Elevance, which is a healthcare payer. I've done really well with Elevance. And those are my healthcare stocks in Solventum. Solventum sells healthcare-related products to dentists and surgeons and so forth. So the Clove stock, really exciting that they're doing everything they're doing, but it's not an investment for me because I'm already good with healthcare. I don't need another healthcare stock. I think a lot of the gains are already priced into the stock. 42%, potential upside. That looks pretty good. If the news continues to be consistent that, hey, these guys are going to be growing consistently, this would be a nice long-term gainer because they're probably going to get back to $10, $20 per share. Well, that would be a multi-bagger, right? So keep an eye on Clove. I'm good with healthcare. I'm going to put it on my watch list and keep an eye on it. Probably give it another quarter or two to see if they repaired the business and then probably buy, because if they're repaired their business and they keep growing, looks like a solid business. So that's Clove. Looks like, okay, Brad wants to look at, would you add? So you want to look at CELH and PayPal. And I think CELH is Celsius. CELH and PayPal. So let's look at Celsius. All right, I got a score update on the Rams-Cardinals game. Looks like Cardinals are just dominating the Rams. 21-0 in the second quarter with 13 minutes to play in the second quarter. The Rams are getting dominated. Okay, so we are looking at Celsius. Celsius is a beverage company. They have an exciting product that's competing with like Monster. Looks like my Google Finance app is not updating. Over the 5-year, look at that. Woohoo! Man, what a rise. But over the 1 year, oh no, look at the drop. So they're down 66% from the high. And let's take a look at the business, see what's going on. And they are a $33 stock. They have a market cap of 7.8 billion, and they're competing against like the big guys in their industry are Red Bull and Monster, and maybe some other beverages, but those are the two that I'm familiar with. Okay, so when we look at their fundamentals, and I've looked at this stock a few times, but I don't know that I've seen it recently. So their growth is really incredible, right? Like, wow, this is really good growth. And I think there was some news where Monster shut them out of some region because Monster made an agreement with a big distributor, and that was deemed to be a big headwind against these guys, that hey, they're going to have a hard time growing because their distribution isn't there. It's still a pretty good grower at 23%. It just is not growing 100% like it was before. And Monster is really big. So is Red Bull. So the growth is slowing down. When we look at the quarterly, well, we are looking at the quarterly, sorry. Quarterly, 23%. Annually, 56%. So it's really slowing down. Okay. This was June 30th. Okay. All right. And they are profitable. That's good. Free cash flow of 245 million, 246. They are growing that cash flow nicely. So 246. Debt is no debt. Very good. And cash is 903 million. Okay, so what do analysts think about this stock? So we have 15 analysts covering the stock. They're saying it's really discounted. They're expecting the company in 2024 is going to have $1 per share of earnings per share. It is still growing, so that looks good. Okay, let's put that into a model really quick. I think it's Celsius, right? So Celsius is a smaller company, but not quite as small as the company we just saw. Not quite as troubled. So I'm going to go like 9.5. And their free cash flow was 246. It's growing really well. So I'm going to go plus 246 times 1.1 just to kind of get us in the ballpark. And the terminal value will grow at 4%. Those growth rates are over here. We can't see them, but I knew they were that because we just used them. Now the cash on the balance sheet's 903 million. I think they had like 1 million in debt. So the equity value is 6.2 million, and the market cap is $7.85 billion. The shares outstanding are 233 million. So I did something wrong there. Put the data in the wrong field. So the stock is fairly priced. You know, it's pretty much. So here's some equity value. And I did this. I think I updated this field, and I need to replace my formula. 1 second. So it's 21% priced at a premium. So it's not a big premium, but this is a stock that I would say if you think their business is going to recover and get on that accelerated, growth rate, maybe. But investors are pulling out of it. They think it's just going to be a small beverage company, and the big guys are going to defend their turf quite effectively. We look at earnings per share. This is where analysts are saying, and 15 analysts are saying, hey, this is really discounted. It was $1 per share was the earnings per share expected. It's a growing company. 24 is fine. And then it's supposed to grow nicely. So I'm going to go with 15. And even if I look at the earnings per share, it's hard to get the company to value at its current stock price. So it's showing a premium on the stock. And this company does have a fair amount of risk because they're going against some really tough competitors, right? Monster's already there. Monster's got a great brand. They got great advertising. They got shelf space. Looks like they're making agreements with other distributors so that they can have really good access to certain markets. So this one here would be a pass for me. And I'm just not seeing enough value. I'm seeing too much risk. I think these guys are going to continue to struggle against the big guys. You want to look at PayPal. And PayPal is a stock that I already own. And I should be able to get right to a valuation. I imagine that everybody knows who PayPal is. And my analysis was on July 30th, but that was after their earnings, I believe. So overall, their cash flows are really good. It's a really good cash flow generating company. The market at times just really punishes certain stocks and the investors that own those stocks. In the case of PayPal, they've been doing okay recently. So for the last month, they're up 3%. But you can see that they hit a certain point, and then it really rallied. It rallied up 22%. For the year to date, the stock's doing okay, 14%. It's not bad. For the 1 year, it's 9%. But if you look at the 5 year, you see this stock was really high during 2021, and it really sold off. Man, 83% sell off. That's huge. At the same time, you'd think to yourself, well, revenues must be collapsing. The company must be collapsing. And the fact is that it's not. Just the market did not like PayPal. There's a lot of reasons why the market thought, hey, PayPal just is undesirable, but it was never about fundamentals. When we look at their growth, the company's been growing. So they're growing their revenue top line. They did have some operating costs that had to get through the system. But you look at the revenue growth has been there. Cash flow, the balance sheet's excellent. Cash flow wise, look at that cash flow. They've always cash flowed really well. At $6.7 billion, looking at their market cap, even though they've rallied a little bit, it's about an 8 or 9% yield of free cash flow on their market cap. That's very good, much higher than other companies. If the company continues to grow their revenues, it's just going to keep rallying. It's a stock that I've put a pretty good bet on. When I look at PayPal, I've invested $49,700. The stock's worth $53,797. So it's that type of position. I continue to buy shares. I think PayPal is beginning to work, and it's not going to stop. I think the fundamentals really are good for PayPal. So I want to load up on PayPal, maybe take that position up to 70,000 and see where it goes from there. So I'm a buyer of PayPal, and I think they're on their way up. I think a lot of the negative speak about PayPal is behind them, and I think they'll start doing better. So there you have it, PayPal. All right. quick glance at the game. Looks like the Rams are on the board. The Rams scored a field goal, 3 points. Now it's Cardinals 21, Rams 3. Not much of a game. Interesting. Let's see what other game is on at the same time, because this isn't the most exciting game if it's going to be a blowout. On the other channel, Kansas City, Cincinnati, 3-3. Looks like Joe Cool is leading the Bengals. First down Bengals. They're in the red zone. Bengals trying to make some noise. Bengals are 0-1. They didn't have a very good season last year. They were in the Super Bowl a couple years ago, and we're supposed to be a pretty competitive team. We'll see if they put it together this year. All right, so let's go over, I think Mercado Libre is the next stock on deck. Let's take a look at Mercado Libre. So Mercado Libre, I like the stock. I like their growth. But there's really good choices in this space, right? I already own Alibaba and I own Amazon. I continue to accumulate Amazon. And man, I can't buy another e-commerce company. I think it's great that they're down in Latin America, and doing well down there. But for me, I'm not jumping into another e-commerce company. I'm going to make sure that I diversify appropriately. Amazon's a great company. Alibaba has been doing nothing. Maybe I should sell Alibaba and buy Mercado Libre. Over the year to date, 38%, solid. Over the 1 year, up 52%, very solid. Last time I valued Mercado Libre, they were priced pretty much fairly. And I'm like, it's hard to buy a stock that they're not necessarily a very well-known name. And they're already at $107 billion market cap. So it's not like you're buying this tiny company where they can double in value. Bad news can find them, and next thing you know, boom, you lose 50% on this investment. I'm not saying it's going to happen, but that's what goes through my head. So let's take a look at evaluation Mercado Libre and see where we're at. Let's use Gemini this time. We'll get all our fundamentals from Gemini, from AI. We'll have AI do some of the work for us. So Mercado Libre is a higher risk stock for me because it's out of my home country. I'm in the U.S. It's a smaller company. So I'm going to say, hey, I want a rate of return of 10. It's a good company, but it's outside my home country. So I'm going to ask for a higher rate of return. All right, Google Gemini. What is the free cash flow for MELI? Free cash flow for the quarter ending. So free cash flow for the quarter ending. So one thing I want to update is what is the annual? I want to make sure it doesn't give me the quarterly. All right. Oh, so now Gemini is saying that they've shown impressive free cash flow growth, but it didn't give me a number. Oh, interesting. It gave me the quarterly number, but not the annual number. Okay. We'll have to go back to stock analysis. All right, so here we need to look at Mercado Libre, MELI. And we're looking for free cash flow. We're going to just jump right into what I look for. Free cash flow. So 1.7. Am I looking at quarterly numbers? Yeah. So free cash flow for the trailing 12 months is $5.6 billion. That's a very good cash flow rate, by the way. So, and they are growing it quite dynamically, quite fast. See that growth rate? Wow, that's really good. That's pretty incredible. So I'm going to grow it by 20% in the first 4 years. No, I'm not going to grow it by 20%. I'm going to grow it by 15% because the growth rate from 23 to trailing 12 months is about $1 billion, and that would be about 24%. And as the number gets bigger, it gets harder to grow by the same percentage, right? The law of big numbers. So I'm going to go 5, 6, 2, 8 times 1.15, and we'll grow the first 4 years by 15%. And then after that, we will grow up 4%. That is fine. So the intrinsic value is $131 billion for the company. And let's take a look at cash and debt. So cash in short-term equivalents are, $6,891 million. And debt, total debt is $5,454 million. So equity value is 132. Their market cap is $107,600,000,000. Shares outstanding 50 million shares. So their stock is being discounted by 23%. All right. So free cash flows look really good for Mercado Libre. Very good. And if we look at what analysts are saying about them, it's a strong buy. They have a slight discount. The earnings per share that they're using for that valuation is $36.08. And one thing I have to check is what currency are we dealing with here? I should have checked that first because this is outside the U.S. Okay, U.S. dollar is good. All right. So everything that I was talking about is correct. I was afraid. I believe these guys are headquartered in South America somewhere. So I just wanted to make sure, hey, are they using another currency? Now, this is a growth company, so they deserve a higher multiple. They're growing really well. Really well. So I'm going to go with P of 40. And their analysts think that it's going to grow from its current earnings per share and grow at like 30%. So I'm going to grow at 20%. So collectively, it's discounted by like 10%. So it's not incredibly discounted stock. Part of it is that the stock's really been working for investors, right? So, I got to make a decision. Hey, do I buy into a really interesting company or do I continue to watch it, do its thing? Now, this would be a stock that if we had a pretty good pullback and this stock maybe dropped 10, 20%, maybe 30, then it'd look really good. So it'll be on my watch list. So I'll put that guy on my watch list. That's Mercado Libre. All right. So it looks like Cincinnati is on top against the Kansas City Chiefs, 10-3. Very nice. Very nice. So till the end, it is the Amazon of South America. I get that. Yeah. And you own them. Awesome. Yeah, a split might make sense because $2,100 is a pretty expensive stock. And I know that most people would invest more than that, or you can buy fractional shares. But when you look at options, right? Like options, you have to do multiples of 100, like 100 shares. And that becomes like a really expensive option. Like if you were to sell a call, buy a call, if you were to buy a covered put, you're talking about, you know, would that be $210,000? Like if you sold a covered call, you'd have to have that cash, you know, on hand, or you'd have to do it on margin, which would be expensive. But if you do like maybe a 20-for-1 split, I don't know what they would want to do. Maybe if you're going to split, you might as well get your stock price down to like $25. And then it'll be a more favorable stock to look at options. So that would be a good idea. All right, football update. Kansas City just scored a touchdown. Looks like they're going to tie up the score. The Chiefs will be 10, and the Bengals will be at 10. So that's a good game. All right. Okay, so that's Mercado Libre. Pretty good stock to watch. It looks good. Maybe just liquidating my Baba position and moving to Mercado Libre is a pretty good idea. So I'm going to watch this guy. All right, so moving on the list, DraftKings. So DraftKings, if my memory serves me right, the rub that I had with them was that they weren't profitable, and it was kind of not a high cash flow generating situation. It's been up, down, up again. Year to date, up fairly good. 12.5% isn't bad. The 1 year looks good. 22% looks good. Okay. And then
Let me get a cantina chicken burrito and bowl. You have a golf course in your house? Bro, I got a Taco Bell in my house. Right.
So this is an $18 billion market cap company. When we look at, they have been growing pretty well. They're now a $4.3 billion revenue company. Very impressive. They are losing money. Wonder why they keep losing money. That's a pretty good revenue rate. So that's some homework. Like, why are they losing so much money? Free cash flow. They are producing free cash flow. And if we look at the quarterly, yeah, I don't like seeing this like positive cash flow, negative, a little bit of positive. It's hard to get confident if they don't have an upward trajectory, like a nice smooth, hey, now we make we're making money and we generate cash, and here's the run rate. And you can put a nice growth rate to it. So this one here, I can't get to a solid cash flow number. I'd have to guess at it. So if it was $150 million of free cash and maybe growing at 10%, this stock could be worth like $3 billion, but it's priced way higher than that. If you look at their 26 analysts cover it, and they're saying, hey, it's a strong buy, it's discounted. Now, why are they saying it's discounted? So they're going to lose money. This is totally speculation, right? Like, hey, eventually they're going to be really big and they're going to be really important and they're going to make a lot of money. So that's all speculation. It's not on fundamentals. So it's outside my wheelhouse. I can't analyze it. I can't get to a kind of a intrinsic value. So I'm going to pass. I'm going to pass on this one. And that's basically where I arrived last time I looked at DraftKings. So thanks for asking. I think we wanted to go over GGAL. So GGAL. So this is Grupo Financiero Galicia. So Grupo Financiero Galicia is a financial service holding company, provides various financial product services to individuals and companies in Argentina. It operates through banks, Banca X, insurance, and other business units. Okay. So this is an $8 billion market cap company. They are listed on the NASDAQ. Okay. Very low PE. Stock has been working. It's been working really well for the 1 year. Now, this is in the Argentinian currency. So net interest growth is really high, but I think Argentina had an inflation problem, right? Yeah, so they have high inflation, right? So in order to get people to put money in your bank, you have to like pay a really high interest rate. And it's kind of like, it's a very confusing and I think risky environment. So I would pass. I don't want to become an expert on Argentinian inflation. I could just say it's very high inflation. And I've heard stories that their economy is kind of in a place where they have I think it's a prime minister is what they call it, or a president who promised a lot and has really disrupted the economy in a lot of ways. Fundamentally, because he needed to control, I believe, inflation in a couple aspects. Not saying he's doing a bad job or a good job. I'm just saying it's a country in trying to repair itself. And it's too risky for me. You know what? I can make money with companies here in the U.S. Thank you. And I'll leave it up to people that really know Argentina. I don't. So I'd have to pass on this one. It's outside my domain. It's too risky. You know, I need my capital to continue to grow. All right. So Fallsgrave. Yeah. So you missed the beginning of the live stream. I'll just kind of read your comment. Next couple of weeks are generally downtimes for the market. So seasonally, September, October tend to be bad. Like stocks go down. And my opening comments were, I expect that to be the case. I expect, September, we should have a pretty good sell-off. I don't know if this next week is going to be a sell-off, but if I had to, if I only had two choices, is it going to go up or is it going to go down? I would say the stock market is going to go down next week. And it's going to go down over the next 7 weeks because seasonally it tends to do that. And then second is we have this election, and the election is just going to put more fear and concern into people's heads and investors' heads. And they'll probably just want to, sell and kind of stay out of the market for the next 2 months and then come back and make investing decisions in late November and in December. So that's what I opened up with. All right, cool. Thanks for asking about those stocks, guys. Looks like the game is tied up. Cincinnati Bengals, Kansas City Chiefs, tied up at 10. Second quarter, 6 minutes remaining in the quarter. This is a really good game. Looks like the Bengals are trying to establish their season. I think they're playing in Cincinnati. So, Kyla, what do you think of SPYI? Let's take a look. SPYI. So the NEOS S&P 500 High Income ETF is an exchange traded fund that mostly invests.
And Chase, that's angle. Rolling around near the 10-yard line. Pass interference. Defense number 22. Almost placed in spot of the foul. Automatic first down.
Well, I usually don't buy ETFs of this type. You know, I have kind of a recipe for success with my stocks, and I just follow that recipe. This one here, they're doing some pretty sophisticated stuff. The results, let's see, for the 1 year, it's up slightly, but the dividend is really high. You can see that it's had some volatility in the past. So it's had a good rate of return for a year. But with a 5 year, you're basically hopefully collecting a really high dividend. So if you want a high income investment, this might be up your alley. I don't need that. You know, I don't mind getting paid dividends. I don't mind a high dividend. But what I want is I want a stock that's going to double, or an investment that's going to double in value in the next 5 years. This one's not it. I don't buy a lot of ETFs, and principally because, you know, I'm very comfortable with the stocks I own. I'm comfortable with my method and my success rate. I buy bonds. I tend to buy individual bonds, and I buy real estate, and I own real estate. I actually own the real estate that we rent out to residential renters. So thanks for asking. Interesting investment. It does pay a really nice dividend. So it looks attractive to somebody that wants income. I can't tell you if it's risky or not. You'd have to do your homework on it. I don't get deep into ETFs like this. I don't have the tools to do so. Yeah, thanks for tuning in, Kyla. I don't know if you've been to the live stream before, but it's great to have you. How about KLLKALU Kaiser? So materials, right? So I got a few things to say about materials. So Kaiser Aluminum. So over the past year, it's down 10%. Over the last 5 years, it's down 30%. No, not good. Now, material companies, they're not doing so great because we're supposed to have a recession, right? It's not supposed to be really ugly, but it's going to be a recession anyway. And it might be a good time to look at materials companies. Kaiser is an idea, but I would say you might look at different materials companies because you might be able to buy something now or in the next couple months or next 2 quarters that really starts to work a year from now. And you can buy some really well-known names that are pretty dependable. Kaiser has been around for a long time. Let's take a look at the fundamentals. Hasn't been doing great, but let's take a look. It's a really low market cap. Amazing. I would have guessed that it was much higher. They have revenue of $3 billion. The PE right now is 27, but in the future, it's really going to drop. So it looks like profitability is probably going up. Nice dividend. Analysts say it's a buy and it's discounted. So when we look at their revenue, the revenue is going down. Again, we have a slowdown in progress. It's expected we're going to go into a recession. We're beginning to see a slowdown. Man, look at that. It really screamed up in 21, but maybe because they kind of had a setback in 2020 due to COVID. And then 22 had good growth, but then they kind of hit a wall with regards to growth. You look at the quarterly. The good news is their revenue decline is decelerating. At some point, that is going to turn green, and they'll begin to grow again. All right. So they are profitable in the most recent year, and they do have free cash flow. So this stock here, I could substantiate this valuation and say they've probably hit the very bottom of their valuation, and it could really go up. You just have to pick the time when you think this is going to be like the lowest point, and then there will be some good news about, hey, there's good prospects that the economy is going to start growing in 6 months. Again, right now, nobody wants to think about that. Everybody's thinking about this election. So it might be a good stock to think about like in December, Kaiser, because I think I could value the company above $1 billion. And it looks like, let's see, analysts think it's discounted. They're using an earnings per share number of $3.10. That's very good. And it's more than double next year. Yeah, this is really going to be an exciting stock eventually. If all holds together, like Kaiser Aluminum, right? Aluminum goes in airplanes. They're building a lot of airplanes. They're, like the travel is really at a peak historically. Aluminum goes into the aerospace and defense side. So defense is always in demand, because the country wants to have a good, strong army and air force and navy. So this is a pretty good idea, Kaiser. I think it's worth watching, following it, and at the right time, picking up some shares potentially. So I'm going to watch it for a while. Thanks for asking. That's my opinion on Kaiser. So, yeah, we talked about Moderna a couple of days ago. It dropped so much because, the COVID era is behind us. They had phenomenal years during COVID. Their revenue went from, they were like a $60 million company, and all of a sudden they're like 17.6 billion, 18 billion, but now their revenue is really contracted, but not down to zero, right? It's still a $5 billion revenue company. Quarterly wise, yeah, it looks pretty bad. They're back to being a pretty small company. So this is the big drop is because Moderna had one, treatment, which was for COVID. And boy, did they make a lot of cash and profit. Now they're trying to develop like the next line of I guess for them, it would be vaccines or therapies of that type that they could use and help people with other illnesses. So if they're able to pull that off, I think it's going to be a valuable company, but that's what the market's doing. It's contracting because, hey, they're burning cash. And the best is behind them. So I'm not quite sure where this one's going to go. Pfizer had the same problem, which was Pfizer had their revenues really peaked in 2021, 2022. And then years after that, the comparisons were like really difficult because they didn't have COVID vaccine sales in their 2023 numbers. But now their compares are beginning to look really good because they're no longer comparing against years where COVID vaccine sales were in them. So I really like Pfizer. It's an investment that I have. Moderna is not diversified. Moderna was a one treatment company and they boomed and now they're a bust. So that's what's going on with Moderna. All right, so we've been going for an hour and 23 minutes. I'm going to take a break. Update on the game. Cincinnati is up 13-10. I think they just got a turnover. So the Chiefs are going to have to put it together to be competitive in this game. So thanks for tuning in. I'm going to take a quick, maybe 15-minute break. If you guys want to hang in there with me, that'd be great. But if you don't, I understand. I hope you enjoy your Sunday. I'm going to return, I'm going to say at 2:45 Pacific. Actually, I return at 2:50 Pacific, which is in roughly 18 minutes or so.
So I like honey barbecue. You like honey barbecue. I like football. Like
All right. So I'll be right back. I'll tell you what, I'm going to share a video that I created. You may have already seen it, but I think I released a video of the most overpriced stocks. So see if you guys enjoy it. So. Stock market's gotten rather expensive, and the prospects of finding companies that are discounted, that are really good deals with regard to their stock price and overall future, has gotten harder. But finding companies stock market's gotten rather expensive, and the prospects of finding companies that are discounted, that are really good deals with regard to their stock price and overall future, has gotten harder. But finding companies that are overpriced is a lot easier. And I wanted to point out 4 companies that I think are grossly overpriced. They are overpriced by a big margin, and I wanted to point that out. In some cases, some of these stocks I would consider shorting, and I'll let you know which ones I'm probably going to establish a short position on, and which are just interesting to look at, but maybe a little too dangerous to put into a short position. Now, overall, even investors like Warren Buffett really find companies that are highly overpriced, and he doesn't short stocks. He just doesn't have the scale, as he said, to really pull something like that off. And if you could imagine, a great investor like him shorting a stock would probably really hurt that company. But me, I'm just an individual investor, and the companies aren't even going to notice if I do it. So it'll be interesting to try it on a few of these stocks that I think are grossly overpriced. So let me start off with the first stock that I think is grossly overpriced. The first stock that I think is grossly overpriced is Tesla. This company has seen its stock really rise a couple years ago, and investors were really excited. It became a Magnificent Seven stock because it really rose to a very high valuation. But since then, the company's really hit, or I should say the stock of the company's really hit a skid. It's down more than 43% from its high. Overall, I think investors are mixed. Some people believe it's a car company, and if you're in that camp, this is grossly overpriced. Other investors believe it's a tech company, and they believe that it has a promising future. So I'm more of the camp that they're an auto company, and they're beginning to behave that way. I'd like to point a few things out with regards to the revenue, their cost, their profitability, which is going to be a big anchor on their overall value. I think it's going to limit them. The volume of cars they try to sell and the competition they're seeing around the world. For example, China is coming out with a EV that's really good, and they're going to compete against Tesla around the world. So Tesla is going to find it very hard to continue to grow. At this point, they're not growing very much at all. Let's take a closer look. Over the last trailing 12 months, the company has only grown 1%, not a high growth stock like a lot of people believe it is. It once was a high growth stock. A couple of years ago, it was growing very fast. That's great. But you can see the competition is really getting to Tesla, and it's not going to change. It's just going to get harder and harder to sell their cars in a marketplace that has a lot of competitors that have a very good product in the form of EVs. Some people may say, well, this stock is really transformational. It's a $735 billion market cap. One big concern I have with this particular stock and company is their CEO is a rock star, but they have to share him with 2 other big companies, SpaceX and X, which was once Twitter. And it seems like Twitter really takes a lot of his mind share. Can he really pull that off? No other CEO for any big company really shares his time across 3 different companies. I think that is, if anything, confusing, and Elon's probably distracted at any one time. How could Tesla continue to operate and compete against other auto companies that really are focused on making the best cars for their customers? Their PE is really high, 64. This company is not growing. Big problem. Future PE, 82. Again, not growing. Analysts believe it's overpriced. Now, I believe it's overpriced by a very, very big margin, which I'll show later. With regards to their cash flow has declined. The company is in the auto industry, and they have had to put more capital back into their factories. They only produced $1.7 billion of free cash in the trailing 12 months. That's tiny compared to the market cap. That's somewhere in the neighborhood of 1% of free cash flow yield on that market cap. So that metric looks terrible for Tesla. I value companies based on their free cash flows as well as their earnings per share and establish a net present value, the cash flows they're going to produce in the future, as well as the earnings per share. Collectively, I think that Tesla is overpriced by 83%. If you consider their cash flows that they're operating with, which are very, very low, and then you look at their earnings per share, which is also based on their market cap, very low. I just don't quite understand how investors have been invested so much in Tesla and believe so much in the company. It is a car company. Maybe they're twice as good as GM, so maybe they deserve twice the market cap of GM. That would put them basically at the valuation that I'm putting forward here. So overall, Tesla is really overpriced. Now, is it a stock that I would short? The answer is no. I think with Tesla, there's just too many fans of the company. Each time that Elon pumps up the stock rallies for no apparent reason. There's no fundamental driven reason, but he's a rock star. And for the time being, it's a stock that could really go up 20, 30% just when Elon puts out a pretty big speech or drops some type of hint that the business is going to do something really special. Remember, he could say whatever he wants, but if you follow the execution of the company, they're falling behind on various marketplaces. And I think it's a stock that's really going to disappoint shareholders in the future. Palantir is a stock that's really overpriced. It's a company that has an exciting product, but when you get down to their fundamentals and study their revenue growth, they're not growing very fast and they're not very big. So it's surprising that investors are so excited about this stock. I would understand if they were growing at 100%, but as I'll show you later, the growth isn't quite amazing. It's almost average to their industry, yet their valuation is well above their fundamentals. Let's take a closer look. Palantir has a market cap of $79 billion. And I put alongside it two other software companies for comparison. Microsoft is the biggest company that is a software company at over 3 trillion. And then Adobe, a well-known software company, is at 238 billion. The revenue of Palantir is just 248 billion, while Microsoft's over 245 billion and Adobe is about 21 billion if you look at the trailing 12 months. When we get to PE, that's where you really see a stark difference. You have a PE ratio of 210 on Palantir. That's really high. The PE on Microsoft's only 36, and the PE on Adobe is 45. We go forward PE, the Palantir PE drops to 89, but again, Microsoft is a third of that PE. And this is a really well-known company. And Adobe looks really attractive at 27. Again, another well-known company. Now you might say to yourself, well, they're just growing much faster. And the answer to that question is not really. If you look at the growth of Palantir, they're growing at 21% if you look at the trailing 12 months, and they're just a $2.4 billion company revenue-wise. Adobe is growing at 11%, and they are a $21 billion revenue company. So that growth rate really adds up to more than $2 billion of additional revenue they're putting on that income statement, whereas Palantir is only putting close to 500 million. So Palantir is overpriced if you look at the revenue growth compared to Adobe. Adobe is growing much larger from a dollar perspective, yet their PE is much lower. Microsoft is also growing quite well, 15.67%, not too far from where Palantir is at. But you can get Microsoft's PE at 1/3 the PE of Palantir. If you look at some smaller software companies like Zoom, they have $4.5 billion in revenue. They're growing slightly, much lower. But if you look at their valuation, it's much lower than Palantir. You can get Zoom almost at a very good discount, as well as DocuSign. DocuSign is growing almost 8%. It is larger than Palantir, and you can get DocuSign at a really good discount. So in the realm of software companies, I think Palantir is just really overpriced, and investors have really good choices for software investments that I think have better fundamentals than Palantir. Palantir is being sold at a premium of 66% if I value the net present value of their future cash flows as well as their earnings per share. That's a really big premium. And if you look at the market, you can buy Zoom and they're discounted at 71% because they generate more free cash flow. They're growing that cash flow just as well as Palantir. They have an established business. They're also bigger. They have a bigger enterprise value. So again, within the software space, Palantir is not that special, yet they command a really expensive stock price. And that's why I think Palantir is a very grossly premiumed stock. It is overpriced by a big margin. And I am going to start a short position on Palantir. I think it's a good opportunity to get probably a 30% return in the next 6 months, because I think we're going to see headwinds on stock prices in the month of September and October. And I'm willing to bet that Palantir stock is going to drop in value. The next stock that's grossly overpriced is TSM. Taiwan Semiconductor. I've known of this company for a long time. I was a multi-year investor in TSM. I tripled my money investing in TSM. I think it's a great business, but the stock price is not the company, and the company is not the stock price. The whole AI hype has really created a big expectation that the data center is just going to expand quite fast. And as a result, TSM stock's really high. But when we look at TSM's revenue growth, it is not showing a hockey stick like growth. It's actually just showing okay growth. Trailing 12 months, it's up 9%. In 23, they were down. And that's right in the middle of the AI hype. Why weren't more semiconductors being produced? And I think there's more fluff in that whole AI hype cycle than there is fact. And I believe that Taiwan Semiconductor is overpriced by a big margin. I believe TSM is overpriced by 55%. And you could tell that the stock's been appreciating, but the revenue hasn't really been growing. Their free cash flows haven't been growing. So when I value the company based on free cash flows that I expect, as well as earnings per share, it shows a big premium of 55%. Now, this would be a good candidate to short, but I'm already shorting two other semiconductor stocks. And I think having a third might be a little too much exposure. So I'm going to hold tight, but maybe begin to short them if things change a bit. And the fourth and final stock is NRG. NRG is a independent energy producer, and the AI hype has made the expectation that power producers are going to make lots of money. And I wanted to begin with the revenue for this company is actually down in the trailing 12 months. So if revenues are down, yet this stock price is really up, what gives? Why aren't they both consistently going in the same direction? The hype is going up, and so is revenue. At least show me some revenue growth. So that's why I think NRG is really sold at a premium, grossly overpriced. When I look at free cash flows and earnings per share for NRG, they are priced at a premium of 45%. And this is a utility. They grow very slow. But in this case here, they've actually been contracting the revenue. So that's just amazing. This stock's been pumped up so much if the revenues are actually declining. Now, would I short NRG? Not at this moment. I'd like to give it some more time and consider it in the future. But I just wanted to point out how overpriced this stock is. Those are the four companies that I think are really overpriced. Now, keep in mind that I truly believe that stock prices are not representative of companies. Companies tend to be really good entities that create products and services that provide something to a company or a consumer that gets value out of it. So the stock is not the company, and the company is not the stock price. And I'm not saying anything bad about those companies. I'm just thinking these stock prices are just too high. And they present an opportunity for an investor like myself to take advantage of the exuberance that's been exhibited in these stocks. I hope you found it interesting. And keep in mind, I'm just an individual investor sharing my experience, my thoughts, and my opinions. I do not recommend you short any of the companies that I just talked about. I don't recommend you buy, hold, or sell any of the companies I just talked about. Please weigh your decisions really carefully with regard to your investments. Good luck investing in 2024.
all-hybrid Camry.
Toyota. Let's go.
Okay, 500 deluxe garden gnomes. Wow.
I only meant to order 5. There's not enough money in my account for these. I'm gonna get charged.
2 things I just can't deal with: overdraft charges.
Hey, welcome back, everyone.
But you're being more smarter than executive account gives you that for the day.
Nice to see a bank company.
I was able to get a bite to eat. We can get restarted and catch up on football, catch up on stocks. Look like the Kansas City Chiefs have their hands full with the Bengals. And the Rams are getting routed by the Cardinals. Cardinals 31, Rams 3. Holy smokes. Cardinals came to play. 31-3. Jeez. The Rams look like they're going to open the season 0-2. So we'll see where that team goes. All right. Looks like a couple people on. We were looking at some stocks. We went over some good ones. Mercado Libre looked good. CLOV looked good. PayPal looked good. What are the stocks you want to talk about? And you want to talk football? That's on the table today. It's Sunday. We talk football on Sundays. It's a national pastime. All right, I'm going to lower my desk. I've got a stand-up desk, and I got to pace myself. I stood up for the first segment, but got to sit down for the second segment. Atcor is one of my favorites. So Atcor. Let's take a look at Atcor. What's Atcor all about? All right, let's take a look at this. Looks like Bobby Jean wants to look at Atcor. So this stock's been coming down a lot. Since March, it is down 55%. What does Atcor do? So what does Atcor do? Atcor engages in the manufacture and sale of electrical, mechanical, safety, and infrastructure products. Okay. So they do like a lot of conduit, like the materials you would use like in new construction, maintenance, repair, remodel of infrastructure. Okay. Alternative power generation, healthcare, data centers. So this probably took off with the whole data center expectation, right? That data centers are going to be booming and they're going to grow and they're going to get massive. Let's look at their website real quick just to make sure we understand. They're in Harvey, Illinois, and this is the kind of product they're creating. Now, this isn't a very high margin product. It's they probably make a good quality product, but it's just not very high margin. The revenue, it looks like the revenue really took off coming out of COVID. It went up 65%. Really good year, and then it went up another 33%. But then since then, they haven't been able to maintain that revenue clip. It's down 10%. So yeah, it looks like building components for offices. So office space, needless to say, is really it's the picture's really changed with regard to office, right? Like home offices are really popular now. I think companies, their footprint of office space, they've really reduced it. They don't need as much office space. So building it out is probably not in high demand. Okay, so this stock's down quite a bit. Are they still profitable? It looks like they are still profitable. That's good. And they do generate good free cash flow. So their cash flow is coming down because their revenue is coming down. But at their current cash flow rate of, call it 400 million, I mean, this stock is priced fairly. You could say that the stock's priced fairly. This would be a good stock that if you see this stock is going to begin to grow, stabilize, and then grow, wouldn't be a bad idea. Because it's at some point they're going to start growing again, and then the stock's really going to start to work again. For now, you know, when are they going to start growing? If we're heading into a light recession, I don't know that there's going to be a lot of construction. For sure, not office space, but maybe data center or other types of commercial property construction might start happening. That's what could happen. That could create some demand for Adcore and cause them to begin to grow the revenue. So that's possible. We'll see. All right. So that's Adcore. Interesting little company. What was their, I think their, what sector and industry are they part of? They're the one within the industrials sector, and they are part of the electrical equipment and parts industry. Okay. They've been around for a while, since 1959. Good little company. Looks like they were growing really fast, probably had some really good construction projects, but now they're trying to find a way to grow. PE is really low because their growth is really negative. And analysts are saying, oh, yeah, man, it's a really good buy. It's discounted by 52%, but I don't know that investors are all that enthusiastic about a company that's losing revenue. So that's Adcore. So I think, so Adcore is probably the type of stock that you get in and get out, right? You buy it when the buying is good, and then you get out. Let me try to find a graph that I like showing. So here's a graph that I like to show. And, like Adcore is kind of beginning to go into this zone. And then at some point is going to be a good buy. And then it's going to rise. If you can time it right, it's a good stock to own for a year or two, make a nice 30, 40% return and get out. But I don't know that a stock like that is going to compound year after year, and you're going to wake up 5 years later and it's double in price. That would surprise me. It's those kinds of stocks you want to get in, you want to get out and make some money and then call it a day. So that is Adcore. All right, so coming back to football, the Rams and Cardinals. Looks like the Rams are losing. It's 34-3, Cardinals on top. The Rams are trying to claw their way back, but it's all Cardinals. It is all Cardinals. They're playing in Arizona. Bobby Jane, thanks for asking. I really appreciate you attending. Thanks for asking about Adcore. While we have some time, let me go over a few things. Let's go over first. Let's look at the Asian markets. So is this live? Let's see here. So okay. No, this isn't live. I guess the Japanese markets aren't open yet. They will open soon. Futures, I don't know if this is correct, but futures are a little negative. Oil prices have been going up, which is good because they were so darn low. It's good that we have low oil prices, low gasoline prices, but the oil prices are really making oil companies unprofitable. Hey, this is interesting. But like the Japanese market, they have a lunch break. That's pretty cool. People can take a lunch break, come back, keep trading. Let me look at the economic calendar. This is a pretty good website, Trading Economics. I like checking them out. And it looks like on Monday, no big news. Tuesday, retail sales. Some manufacturing reports. Retail sales are a little interesting, will affect the retail stocks, but nothing more. And some oil reports on Wednesday that might move oil. And then the federal rate decision on Wednesday. So that Wednesday, the big story will be, is the Fed moving 25 or 50? If they move one or the other, it kind of has different meanings. Like the problem with them moving 50% is that people would then be like, oh, see, we're in a bad recession. Bad recession's coming. And that would maybe cause the market to sell off. If they go 25, then investors might be like, well, I kind of wish they would have gone 50 because the discount rate is not as good as it could be. We'll see how the market plays it. But Wednesday we'll see that. It happens at 11 a.m. Pacific, but what that means, it'll be 2 p.m. Eastern. Then beyond Wednesday, we have jobless claims. That's an important report because that tells us, are we going into recession? No recession? What's going on? Existing home sales, that affects real estate. So the two big reports will be Wednesday and Thursday. The Federal Reserve making a decision on interest rates, and then the next day looking at the jobs number. Those two reports could move the market quite a bit. So we'll see where those end up. So something that I like looking at, I was looking at it this morning, Datarama. I don't know if you guys are familiar with Datarama, but it's a website where whoever has this website, they bring together like all the super investor portfolios and show that like there was a change to the portfolio. They put it on here, which is cool, especially around quarter end. That's when you would see a lot of updates, especially like this past quarter end. We found out that Warren Buffett was selling a lot of Apple. Now he's selling a lot of BofA. So good website to keep an eye on if you track super investors. And one thing that they have on there is they have a good, measure of what's in their portfolios and the top 10 most owned stocks. And I don't know if this looks all that great, so let me try to show it a different way. I think this is going to be better. So from that website, what do they own in common? Like, what are the most popular stocks that super investor are owning? Alphabet, Google, number one. Microsoft, no big surprise. Meta, Amazon, Visa, Berkshire Hathaway, Apple, United Health, and MasterCard. So a couple of the payment system, payment platform companies, Berkshire which is kind of an ETF or mutual fund in itself. And then Apple. Now, this means they own it, but from a percentage perspective, most super investors own Microsoft, Berkshire, Google, Amazon, and then Google's split into two different types of stock types. So here's Google again. Meta and Berkshire, two different types of stock. Visa, Carvana made it on the list. And then Joe, let's take a look at Joe. I'm not familiar with Joe. That'd be worth taking a look. And then we'll look at Carvana. Carvana is a pretty amazing story that they came back. They were like today's game with the Rams being down by 31 points. If they do come back, that'd be like a Carvana-like comeback. So we'll take a look at Joe, which is a owned stock. Looking at more data that website provides, this is super investor stuff, right? Like this is what super investors, these guys know what they're doing. They're not perfect. Sometimes they don't outperform the S&P. Sometimes they do. Legendary investors like, Warren Buffett and others are listed on there. So Carvana is a big bet. It's a quite popular one. Some people really bet big. Berkshire. AMR, Alpha Metallurgical Resources. Interesting. That's a materials company. I think we were talking about materials earlier with Kaiser in the stream. Let's take a look at AMR. That might be interesting to look at. So it looks like Mr. 123 Cheetah. Joe is mostly owned by, I think, Bruce Berkowitz. Okay. Well, it might be cool to take a look at. So we'll look at it. And we've got Occidental. I'm sure that's Berkshire that's buying into Occidental. Apple. Equitable Holdings. Equitable is like a financial services company. They're a lot like Prudential. Okay. And then Green Brick Partners and then Salesforce. Okay. Anything stick out there? Any request out there from anybody that's watching? Any of these stocks look interesting for you to kind of dive into? Mike, the dividend investor guy. How am I not seeing that you have a live stream going? All right, we'll look at Oxy. Mike wants to look at Oxy. Occidental, I mean, the oil complex is not a bad place to look at right now. And then we can look at Shell. Looks like Brad wants to look at Shell. Shell is the Dutch oil company. We'll take a look at that. And then top 10 buys in Q2. So they were buying Berkshire, United Healthcare, Microsoft, Uber. I'm an Uber stockholder. That's good to see. MSCI. I'm not familiar with MSCI. Let's do a flyby on MSCI. CVS. Interesting. I just sold out of CVS. I just got impatient with them. Solventum. I'm buying into Solventum. Interesting. Charter. I looked at Charter earlier on my own. I didn't like what I saw. And then Humana. I think, Mike, aren't you in Humana? I think Mike or somebody in our community is into Humana. So that was Q2. And then last quarter by percentage, Lore Holdings, Arch Resources, Shift4 Payments, Molina Healthcare, Apple, Aptiv, Google, Solventum. Solventum is showing up. Very good. And then sold in the last 6 months. Berkshire is selling Bank of America. And then this other investor was selling API Group. Okay. So we got a couple of things to take a look at to pass the time. Looks like the Rams scored a touchdown, making it 34-10 Cardinals. Not very competitive. We are in the fourth quarter. Time is running out on the Rams. We switched the channel because that game is not very competitive. All right, we're back to Kansas City, Cincinnati. They are playing that game in Kansas City. The Bengals are leading the game 16-10. And the Bengals, they're pretty competitive against the Chiefs. We'll see how this game plays out, but that's a good one. All right, so Mike's in Humanities growing it on dips. Let's start there. Let's start with we'll go Humana and then we'll go into Shell. Okay. Bad day. Oh, I did see that Dallas New Orleans game. What happened there, Mike? I got to do a deep analysis there. I won't go there, but that was a big surprise. What happened? Like, I think, but New Orleans last week, they played really well. They scored a lot of points. Played well. This week, ditto. 2 weeks in a row, they've scored a lot of points. And FYI, I like their quarterback. I think he got a raw deal leaving Las Vegas, and it's good to see him do well in New Orleans. So we are on Humana, and Humana is a insurance company. It's a healthcare payer. Year to date, stock's not doing too well. They were trying to merge with Cigna, and it didn't happen. I think the government didn't like it and kind of put a lot of pressure against it happening. And the stock hasn't been doing all that great. But if you look at recent performance of the company, I think it's doing quite well. If we look at revenue trailing 12 months, 26% growth. That's very good. Looking at the quarterly, 34% growth. Wow, that's really good. So let me zero in on the last 6 months here. Man, that is interesting that with that type of growth, I would have guessed that they're seeing nice stock appreciation, but they're not. All right. So good growth on the quarterly. Are they profitable? Okay, they're losing some money. They might be writing off some things. What about cash flow? So free cash flow doesn't exist right now. So it's a company that's turning around, kind of trying to get healthy again. They are growing their top line, so they're probably going to be okay. But the numbers, the fundamentals just don't look perfect yet, and they're hard to value a company like this when you have negative cash flow and they're losing money. So I think, but it's a solid company. They're in a stable industry, and they should probably bounce back well. I'm already in a couple of other healthcare companies. With regard to healthcare payer, I'm in Elevance, and that's my stock. I do fine with Elevance. I was looking at the Elevance chart, and I'm like, yeah, I'll own Elevance. I used to own United Healthcare. I did really well with United Healthcare. And then I switched over to Elevance, and I'm glad. Over the last 5 years, it's up 117%. And I love charts like this, up and to the right. Good job, Elevance. I own 60,000 or so of this stock, and I like stocks that do this. Set it and forget it. Double every 5 years, and we're good to go. All right, let's take a look at Shell. So Shell is a big oil company. They are the Dutch company that owns a lot of resources around the world. It's up 4% over the last year, and they should pay a dividend. Take a look at that here. Since oil prices are down, oil company stocks are down. These guys pay a 4% dividend. So the stock's up 4% plus a 4% dividend. You're doing about 8% if you measure that way. This company, according to analysts, is discounted by 27%. Oil prices are down, so that's really putting downward pressure on revenue. And you can see the oil prices are down. They did fairly well this past quarter. Just to be flat is good. So, okay. Now, when we look at cash flow, oil companies tend to produce a lot of free cash flow. And these guys produced $9 billion in the trailing 12 months, which is very good. What's their market cap? $212 billion. Let's compare them to another like company. And I think the biggest player in their space is Exxon. So I believe it's XOM. And when we look at this company, they're $493 billion in market cap. This is less than half. And they produce a lot of free cash. So when we look at free cash flow for Exxon, $32 billion. So makes sense. These guys produce $32 billion of free cash flow and are worth almost $500 billion. And these guys produce $9 billion and they're worth $212 billion. Now, if oil prices go up, the price of Shell is going to go up, as well as Exxon, Chevron, and the like. It's not a bad time to think about oil companies. They pay nice dividends. It's oftentimes a hedge against the rest of the economy. Exxon pays a 3% dividend. And right now the prices are low for the stock price because oil prices are down. So this is a solid company. This is the one in, this is a Dutch company. Exxon, Chevron are American. British Petroleum is British. So you can buy into the big oil companies and you can take your pick. You can pick the one you want. So that is Shell. So we just covered Shell. And again, I think oil prices are not going to stay down forever. It's a pretty good time to think about them because oil prices quickly just jump up. It takes one conflict, with in the wrong part of the world, and next thing you know, oil prices are really high. So keep that in mind. All right, update on the Kansas City and Cincinnati game. Kansas City just took the lead, 17-16. But Cincinnati did not wait very long to really start threatening that lead. They are first and goal from about the 8-yard line. So we'll see if Cincinnati scores. Boy, Cincinnati likes to play the defending champs tough. Oh, we're going to talk about Oxy. So Oxy, let's talk about oil companies' size. And, we looked at Shell, we looked at Exxon. Those are big, fully integrated companies. When we talk about Occidental, in the oil business, there's three major categories of the type of oil company. You have upstream, these are the oil exploration companies like Occidental. You have midstream, which are companies that are refining, creating useful product, or getting it to its end market, that transportation part of the industry. And then you refine and you sell gasoline, diesel, petroleum products. That's downstream. In the case of Shell, they're fully integrated. They do the whole thing. But Oxy, they're more of an explorer. They own certain rights to explore for oil in those regions, or those lands, I should say. And when oil prices are up, man, they make a lot of money. The issue with Oxy is oil prices are down. So Oxy stock is down. It's down 26%. But so are major oil companies. It's not like Oxy is the only one going down. This is a big holding for Warren Buffett, and he's certainly taken a haircut on his stock. But it's not a bad time to be thinking If you like Oxy, it's not a bad time to look at Oxy. So Occidental, they pay a small dividend compared to the other oil companies. And FYI, when stock prices go down, your dividend yield really goes up because you buy at a lower price, and then your yield on that price you paid of a dividend stays really, really good. So Oxy, the revenues are down because oil prices are down. So when they sell their oil, they get a lower price, and they should be profitable. Yes, they are profitable. Okay. And they should produce free cash flow, which they do. Not as much as they did in prior years when oil prices were higher, but $4 billion isn't bad. Oxy is a good investment. You can value the company at $47 billion. It's pretty solid. It's, take your pick. If you like to be on the explorer side of the oil business, Oxy is a pretty good option. If you want a fully integrated company, Chevron, Exxon, Shell are pretty good options for there. So that's Occidental. It's Warren Buffett's favorite oil stock, and it's done well over time. So Mr. 123 Cheetah, BNPs, please. Let me get to that. Let me write that down. BN. Then Scion Ken. So BN is a great company. And then I'm looking at a different company, Endeavor. Okay. All right. So let's take a look at BN. So BN's been really working quite well. So Brookfield Corporation is an alternative asset manager with real estate investment manager firm focused on real estate, renewable power, infrastructure, venture capital, and private equity assets. Okay. They pay a small dividend. Really, you're buying it to see that stock price appreciate. The revenue, not very dynamic for the last, call it 18 months. Before that, it was growing quite nicely. Look at the quarterly. It's a little red. Not too bad. Just slightly red. So this one here, you'd want to get comfortable around, what is it they're into? The cash flow is negative for the last 18 months. That's a concern for me. And let me take a peek at their website. So they do power, renewable power, infrastructure. Come on now. So they own utilities, they own power companies, they own real estate. Okay. Interesting. So they're a Canadian company. All right. So their revenue isn't growing right now a whole lot. From a cash flow perspective, the cash flow was negative. Not quite sure why. But that would be some homework to look at BN. It seems like they have a solid business. Are they classified as a REIT? I don't think they were. No. Okay. And their dividend's too low to be a REIT. Yeah, so this one here just has some homework just to make sure, hey, is the loss of revenue a bigger issue, or are they going to bounce back and start growing again? That'd be important to understand and get a clean answer on. They're a pretty good market cap. That's a pretty good market cap for a company of this type. So that's BN. All right. So what's the story on this Joe company? The St. Joe Company. What do these guys do? The St. Joe Company. So these guys do real estate development, asset management. They're in Northwest Florida. Huh. So they're kind of a real estate developer. They're small, 3.4 billion. They're growing nicely. Although the most recent quarter, they had a loss of revenue compared to June 30th of 23, which was a really good year, a really good month. Okay. All right. The annual growth rate's really good. Okay. Cash flow. The cash flow, that's good. So this most definitely could be considered that it's a discounted stock. We have cash is 86 million. Total debt, 632 million. I don't think that's a big problem. Let's see here. 632 is their total debt. They do EBITDA of 130. Take that back. They have like over 4 times EBITDA to debt. So that is a concern. They have a lot of debt. Yeah, they have about 4 times EBITDA, and I like EBITDA to debt to be less than 3. So it takes less than 3 years to pay off debt if you needed to. In the case of St. Joe, it'd take them about 4 years, which is too long. That's a balance sheet that's unhealthy. So that'd be a showstopper for me. Other than that, they would be a discounted stock because their cash flow is really good. At their cash flow rate, they're doing like 28% yield of free cash, which is very good. Not sure why they don't pay a higher dividend. They should. But that's St. Joe. Now I know what the Joe symbol is all about. All right, so it looks like the Chiefs, the Bengals scored on the Chiefs again. And man, the Cardinals scored 41 points on the Rams. It's 41-10. Woo-hoo. What happened? The Rams are not playing defense. Back to the Bengal Chiefs game. That one's more interesting. Okay, so we talked about super investors. We talked about these stocks. Let's see if the markets have opened in Japan. Nope, still haven't opened. All right.
Cincinnati. It's all said and done. That's his 99th regular season touchdown pass. One more, guess what? He goes flat. He goes Trotter. He goes flat.
All right. So, any other questions? I'm going to add Mercado Libre to my watch list. So I migrated from Microsoft Excel to Google Sheets, and so far really good. I'm happier with Sheets. I think it's simpler and better. And I have multiple computers, and it was always kind of a drag of, well, where do I put the spreadsheet? I shared it in a common drive, but it would just always take forever to open either because my model got really big. So far, I migrated to Sheets on Friday, and after a couple of days, I'm so far so good. So my watch list, here's my watch list, and I want to put MELE in there. So that is right here. Yeah, thanks for checking in, Mike. Enjoy your dinner. All right, so this guy here. Oh, what happened there? Oops. Okay, so then the intrinsic value that we calculated for this stock was 2,300. All right, Brad, I am curious about your buy strategy. Do you dollar cost average or buy one lump sum, wait for pullbacks? So I like to dollar cost average. It's really hard to know exactly when is going to be the ideal price. So I don't know if there's been an exception over the last 5 years. I dollar cost average. What I would say is, like, I think I've shown, the graphic where, a company becomes discounted, and I'll show, Meta as the example because it really set itself up well. So when the market really sold Meta off, Meta is my biggest stock. I didn't know how low it was going to go, but I just kept buying and I kept buying and I kept buying. And I still buy Meta, but here I accelerated my buying. So dollar cost averaged in on Meta, and it ended up being a really good idea. It's really hard to pick a bottom. I didn't know that, November 4th, 2022 was going to be the bottom on Meta. And I don't know that anybody did. But I sensed, based on my analysis, that it was a very discounted stock, and I believed in the company. So that's the case. That's when I buy. More recently, I'm accelerating my buying on Amazon. So Cincinnati just intercepted the ball, and Cincinnati's winning 22-17 against the Chiefs. Incredible interception, one-handed interception against Patrick Mahomes. Back to stocks. So looking at Amazon, I regretted selling my Amazon stocks. And when I saw this pullback, I just started buying. And I've been buying Amazon on every pullback. And that's how I invest into a company. I really believe in Amazon. I want to be a stockholder, so I buy into it. Some stocks are easy to understand, like Amazon, understand their power. And smaller companies, the one thing I would say, in addition to dollar cost averaging, is how much do I invest in a company? That's the other question that I would like to answer. Let me read your comment first, though. So you bought at times even when the price was above your cost per share. I don't think I buy, like, if I think this stock is worth, let's say $100 and it's trading for 120, I may not sell it because I'm like, no, I just want to stay in the stock. I know that it's overpriced for the given time. I'm not buying shares when it's really over its price. Uber might be a little bit of an exception, but I tend to try to buy when I think it's still discounted. Where was I going to go with? So how much would I invest in a company, right? So like Meta is my biggest position. I've invested 106,000 and it's worth 224,000. Uber, I think Uber is going to be a fantastic company and it's going to be worth a lot in the future. I've invested 44,000. It's worth 75,000. Now, how much do you invest in a company, right? Well, Meta is easy to invest a big amount because it's such a well-known company. We know they generate great free cash, very comfortable. Uber, I really believe in, so I bet 44,000. Zim, this one's doing well. You know, I'm up 44%. Zim is a small shipping company, so my investment isn't that much. It's 18 grand, right? So my comfort level spans from, you know, how well do I know the company? How much, you know, confidence do I have in that business? And then I go from there. Robinhood's another one that I've invested, you know, a good amount, 19,000, and it's done well. But that one right now, I think, is priced a little bit above its intrinsic value. Here's one. CareTrust has done really well. It's a REIT. I've invested 33,000. It's worth 57, and it's trading above its intrinsic value. I am not buying any more shares of CTRE, but I'm just holding it because it's a really good quality company. So rarely do I buy like, oh, you know, CTRE had a pullback at 2%. I think I'll buy. No, I still think it's priced a little too expensively, but I'm not going to sell it because I like the company. They pay a good dividend. I'm good to go. That's been a good performer for me, and I'm going to be all right with that. 3M is also in that camp. Like 3M is just barely at a discount. I've invested 19,000. It's worth 29,000. This all happened like in the last 6 months. I haven't been an investor for that long. So 3M's a stock where it's trading around its intrinsic value. So I'm not going to buy a ton of shares very quickly. And that's how I treat it. So hopefully that makes sense, Brad. All right. So and Brad, I don't have your, I don't know if you can get a hold of me somehow, but if you get me your email address, I'll share this model with you that you're seeing, and I'll share it on Google Sheets. And then, you know, you can play around with it and work with it if you'd like. All right. So looks like the Bengals are driving again. Whoa. Fumble. Chiefs just recovered a fumble. If it stands, they just scored a touchdown. Amazing. Chiefs may be on top again. Yep, Chiefs are on top. Chiefs 23, Cincinnati 22. Woo-hoo. I love football. I love football. I like Sundays. All right, guys. Well, thanks for spending a part of your Sunday with me. I'm going to go watch the rest of this game. It's a good one. And I'm ready to trade next week. So it's Victor H Investing at gmail.com. And I don't want to write it out because then you know how there's bots that are grabbing email addresses. So it's Victor H Investing at gmail.com. shoot me an email. Hey, this is Brad. And then I'll share that model with you. And then you can email me questions if you'd like to. So, all right, guys. Well, enjoy the rest of your Sunday. And thanks for joining me today. Really appreciate it. Good luck trading. Let's see what happens this coming week and for the rest of September. Take care.